Today, I'll be going over the most common questions I receive from business owners that inquire for funding. And the purpose of this video is to educate you guys. That way, when you do embark on the lending process for your business, you have some type of knowledge about how everything works, and you'll be able to make a wise and educated decision for your business. I've been in the finance space as a loan broker the last 4 years now, and I've enjoyed working with many different business owners and entrepreneurs, helping them access the capital they need to help their business grow and expand. I recently realized, though, that a lot of business owners go into the lending process without a clear understanding of how everything works, which for some have led to them making poor and costly financial decisions for their business. So the goal of this channel is to help you entrepreneurs and business owners gain a better understanding of the lending space and how everything works. That way you can become a wise borrower and you can make smarter and wiser decisions when it comes to taking financing for your business. The foundation of this channel is rooted in God's word, specifically Proverbs 4 verse 7, which states, "The beginning of wisdom is this. Get wisdom, though it cost all you have, get understanding." And if you focus on the second part of that verse, it says, "Though it cost all you have, get understanding." The more knowledge and understanding you have of something, the easier it is to make a decision. This is only going to cost you a few minutes of your time, so we'll get right into it. Make sure you hit that like button and subscribe to this channel. I'll be dropping out more content just like this. This is probably the most common question that I receive on a day-to-day basis from business owners, and it really depends on the route which you decide to take. On this channel, I'll mainly be going over traditional and alternative financing options because that's what I deal with on a day-to-day basis. Traditional financing is getting a loan from the bank, and alternative financing is getting a loan from private lenders. In order to qualify for a bank loan, you'd have to meet these requirements: 2 years time in business, 670 credit score, good business credit, 100 to 150,000 annual gross revenue, and your tax returns have to show profit. Banks are very strict when it comes to lending, and you'd have to check off every single box in order to qualify. If you're someone who's solely fixed on getting the best rate, then try your local bank first. 9 out of 10 times, they'll be able to beat out an alternative lender when it comes to getting the best rate. Now, here are some things you should know before going to the bank. Bank loans take longer to fund. Timeline could range anywhere between 2 to 4 weeks. If it's an SBA loan, you may be looking at up to 6 months, depending on the type of SBA loan. Another thing to know is that they will require a lot of paperwork up front. If you get denied by the bank or you just need the money faster, then you could look into alternative financing. The qualifications here are much easier to meet than a traditional bank. For this option, you'll need 6 months time in business, $10,000 in monthly deposits, and a 500 minimum credit score. Make sure that you are operating from a business checking account and not a personal checking account, because lenders cannot fund your personal checking account. Most alternative options are unsecured, which means you don't need to put down any collateral to secure this type of funding. With that being the case, terms will be shorter, up to 24 months. The cost will be a bit higher as well in comparison to a bank, and the payment structure is going to be different. Banks usually have monthly payments. With alternative lending, you're either going to get a daily, weekly, or a bi-weekly payment, depending on the lender and the strength of your bank statements. I am just covering surface level things for each topic for the sake of time. However, I will be making separate videos covering each topic in more detail, so make sure you hit that subscribe button if you want to learn more and become a wise borrower. This is another common question that I get, and this also depends on the route which you decide to take. As I mentioned earlier, the bank is going to beat out an alternative lender 9 out of 10 times when it comes to the rate. So that is the first route you should go if you're someone who is solely worried about rate. What's important to understand about lending is that you don't get what you want, you get what you can qualify for. And a big component of that has to deal with your credit score. If you have a good credit score, 680, 700 plus, then you increase your chances of getting a better rate. However, if your credit score is low, then you should expect a higher cost to the capital. You can easily get an idea of where rates are at right now by simply going to Google and searching what are the rates for business loans. If you're using the Chrome browser, you'll see that there's this cool AI overview that gives you a full breakdown and an idea of where rates are at right now. And you also see different options for different types of programs such as SBA, term loans, lines of credit, equipment finance, and etc. Another thing you can do is simply check your bank's website, and most banks will have the rate listed on the loan product. One thing that you'll see is common with a lot of banks is the word prime or WSJP. And WSJP, which stands for Wall Street Journal Prime, is the benchmark interest rate that majority of banks use as a reference point for their most credit-worthy customers. And at the recording of this video, as you'll see, the prime interest rate right now is 6.75%. As you'll see here, most banks have their rates set to prime plus a certain number. And that just means that the rate would be variable and can change depending on if prime increases or decreases. On Chase's website, which is a common bank that I see a lot of my clients use, you'll see for their business line of credit, their rates range from prime plus 2.2 to 7.15. Again, on TD Bank's website, they have prime listed right on front for conventional lines of credit. Over here, they have prime plus 0. On Wells Fargo, it's the same thing, rates starting at prime plus a certain number. Again, on Navy Federal Credit Union, which is a common bank that I also see a lot of my clients use, their rates right here, as you can see, are tied to prime. So if you do qualify for a bank loan and you want to know the rates, just take the steps as I did here. Check Google first, and then also check your bank's website just so you have an idea and an understanding and you know what to expect. Most people that seek alternative lending have this misunderstanding with the rate because they think it's based off of an APR like a traditional loan. However, in the alternative lending space, they don't go based off of an APR, but they price their capital using what's called a factor rate. A factor rate is a fixed multiplier applied to your funding amount that determines your total repayment. Alternative lenders use factor rates because they simplify the cost of short-term financing. Instead of calculating interest over time, the total payback is fixed upfront. This structure allows for faster approvals, faster funding, and access to capital for higher risk businesses that may not qualify for traditional bank loans. Factor rates typically range from a 120 to a 155, depending on risk profile, revenue, and term length. There are a few key things that I want to note. The total payback is fixed. However, most lenders offer discounts if you could pay them off early. Another thing that's important to understand is that factor rate products are not amortized. Payments are not split between principal and interest like traditional loans. Each payment simply reduces the fixed total payback amount. You can look at factor rates in this angle. If you're given a 135 factor rate, that means you're paying 35% of the funded amount as the cost of capital. As an example, a $50,000 approval at a 135 factor rate, the total payback would be $67,500. If you were to take $50,000 and multiply it by 35%, you'll see that's $17,500. And if you add $50,000 to that amount, that would equal your total payback. Most lenders have origination fees, so you also want to include that in your calculations if you want to get the true total cost of capital. This question, I feel, is asked by business owners that have already gone through the process and they probably dealt with the broker and didn't like that experience, so they want to deal directly with the lender. I am a broker and I'll try not to be as biased in this section, but try to be on level playing field and go over the differences between the two as well as the advantages and disadvantages. A broker is pretty much the middleman between you and the direct lender. The role of a broker is simple. Their role is to understand your goals and your needs. That way they can access their network of lenders, whether that be alternative or traditional, to get you an option that makes the most sense. There's several lenders and there's several brokers in this space, but I'd say 9 out of 10 times after applying online, if you do get a phone call, chances are it's going to be a broker, unless you apply directly to the lender. One of the biggest advantages you have of working with a broker is that it increases your chances of getting approved. Instead of applying to just one lender, a broker has access to multiple lenders and can strategically place your file where it fits best. Another major advantage is negotiation power. Let's say, for example, lender A offers you a $50,000 approval at a 145 factor rate for 10 months. and lender B offers you $45,000 approval at a 138 factor rate for 9 months. A broker can leverage these competing offers to negotiate better terms, whether that's a lower factor rate, a higher funding amount, or improved payment structure. And in this scenario, a good broker should leverage lender A's approval to lender B's approval. That way, they match the dollar amount, match the term, and you get a lower rate, which would save you a few $1,000s. There are also some disadvantages to work with a broker. First thing is broker fees. If a broker secures a traditional loan for you, they will often charge a success or a closing fee. Some brokers may also charge a fee on alternative financing products. One key note, you should not be required to pay upfront fees. Most legitimate brokers are compensated at closing, meaning their fee is deducted once the funding is successfully completed. If someone is asking for a large payment up front, make sure you do thorough research before moving forward. Another consideration is industry saturation. The alternative lending space has a large number of brokers, and while many operate ethically, some prioritize commission over what's truly best for the client. Always perform your due diligence, review the company's website, verify their online presence, check Google reviews, and just make sure you work with someone who clearly explains your options and aligns with your long-term business goals. A good broker acts as an advisor, while a bad broker acts like a salesperson. Make sure you know the difference. A direct lender is the company that's actually giving you the money, and there's several advantages to working directly with the lender. First thing is lower potential costs and fees. Since there is no broker involved, the lender does not need to pay a broker commission. In some cases, this can result in lower rates or reduced fees. Second is speed. If you fit that lender's approval criteria, the process can move very quickly since decisions are made in-house. Another thing is that you have direct access to the decision makers. Since you're working directly with the lender's in-house underwriting team, that makes communication more efficient and helps prevent any unnecessary delays in funding. Lastly is the opportunity to build a long-term relationship. If you perform well and make payments on time, direct lenders often want to continue doing business with you. Over time, this relationship can lead to smoother renewals, higher approvals, or more favorable structuring options depending on the lender. While working with a direct lender has advantages, there are also some limitations to consider. First thing is your options are limited. Many business owners prefer to compare multiple offers before making a decision. When you work with a lender, you are limited to the products they offer. If they only have one program available, that is the solution they'll present, even if another structure in the market may better fit your business. Since there are many direct lenders in the marketplace, if you do choose to shop on your own, that can be tedious as you'll have to submit your documents multiple times and will have to restart the process with each new lender. Direct lenders also operate within their internal credit box. If your situation falls slightly outside of their guidelines, there may be little room for creativity and less flexibility in structuring a deal that's more favorable to you. Lastly is the lack of comparison. Without reviewing competing offers, you won't know if there are better terms or better options elsewhere. Whether you decide to work with a broker or a direct lender, the goal should be the same, and it's to make sure you have the right structure that fits your business, not just any approval. Working with a broker will give you multiple options to choose from and negotiation leverage. While working with a lender, you'll just be limited to the options that they can provide. The smartest business owners don't just look for funding, they look for the right funding strategy. The process, just like everything else, also depends on the route that you decide to take. As I mentioned before, traditional financing will require a lot more paperwork up front. Most banks will require the following: a completed application, 6 to 12 months of bank statements, 2 years business and personal tax returns, a debt schedule outlining the debt the business has, a balance sheet, profit and loss statements, as well as a personal financial statement. Now, the paperwork that you'll need does depend on the bank that you go to, but majority of banks always will require those documents. With alternative financing, it's very easy. You'll also need a completed application and the last 4 to 6 months of business bank statements. With that information, lenders do a soft credit check, analyze your bank statements, and generate an approval for you. If you are approved and agree to the terms, most lenders just require a driver's license, voided check, and a proof of ownership document to finalize the deal. Once everything has been finalized and passes final underwriting, the lender is either going to give you a funding call or they'll just send you an email letting you know that they wired or ACH'd the money to your account. Now, if you stayed up to this part, you should know by now whether or not you qualify. But I'll touch on a few key things that are important. I hate to be redundant, but I really want to emphasize this point because I deal with a lot of people that apply for business loans that don't have a business checking account. And you need to have a business checking account if you're applying for a business loan. Lenders won't accept Chime, they won't accept Cash App, they won't accept Venmo statements, and they won't accept personal bank statements. Make sure you check in with your bank or find a local bank that offers business checking and set up a business checking account. The second thing I want to emphasize is revenue. Majority of lenders require a minimum of $10,000 in monthly revenue. There are some lenders that could also work with $5,000 to $7,000 in monthly revenue consistently. The key word here is consistent. You want to apply when your business is doing good. I talk with a lot of people that say business is doing fine, I don't need any money. However, that is the best time to apply because you increase your chances of getting an approval. What I always recommend for clients is don't wait for business to slow down or don't wait when you enter your slow season to apply for funding. Always apply for funding when you're at your peak. And even if you don't need the money, just apply for a line of credit because that's money that you'll have on standby for when you do need it. Thank you for tuning in. I hope that you got more knowledge and understanding about the lending process, and hopefully the next time you seek out financing, you could apply what you know. As I mentioned earlier, I will be making separate videos going into more detail about each topic that I made in this video. Leave a comment below and let me know which one you'd like me to cover first. Also, make sure to like this video and share this with any business owner that you know, especially if they're looking for financing. Lastly, subscribe to the channel if you want to learn more and become a wise borrower.